Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are flat today. Pretty slow news day. Nasdaq is up 0.3%. S&P 500 is pretty flat. Oil prices are down $1 to $67 per barrel, and the yield curve has steepened just a bit. 10-year Treasury yield is at 4.43%. S&P 500 heat map shows some of the chip stocks, semiconductors, for example, Micron down 4%, but Nvidia is flat. Broadcom is up 0.6%. Apple is down 1%. Tesla is up slightly. Meta is up 1%. Microsoft flat. Palantir is up 3%. This week we have bank earnings coming up, and banks up slightly today. Let's move on to, aside from bank earnings, we have lots of economic data coming out this week. Tomorrow, we have the CPI data for June, expected to be 0.2% on the headline and 0.3% in core CPI. My expectations along the same way. These figures are up from 0.1% in May. And then on Wednesday, we have PPI, expected to be 0.2%. And at Thursday, we have retail sales, initial claims, and other data. All right. Let's continue with our daily article. Wall Street largely flat as tariff fatigue persists, data earnings eyed. Wall Street traded in choppy waters on Monday as investors shrugged off another round of tariff threats, turning their focus instead to a business week on economic data and the kickoff of the second quarter earnings season. President Donald Trump ramped up trade tensions over the weekend, vowing to slap a 30% tariff on most imports from the European Union and Mexico starting August 1, a move that leaves the clock ticking for last-minute trade deals. EU extended its pause on retaliatory measures until early August, holding out hope for a negotiated truce. The White House said talks with the EU and Canada and Mexico are still underway. Investors barely blinked, having grown numb to Trump's barrage of tariff threats and his frequent last-minute U-turns. Instead, all eyes shifted to the kickoff of second quarter earnings, with Wall Street's banking heavyweights set to report on Tuesday. Investors were also bracing for Tuesday's consumer price data, which is expected to reveal an uptick in inflation in June as sellers start passing on the cost of sweeping tariffs. Meanwhile, Wednesday's producer and import price reports will offer fresh insight into how supply chain pressures are shaping up. It is a pause ahead of a really big news, which is CPI and earnings. Nobody wants to get offside ahead of the big news, said Jay Hatfield about today's action at Infrastructure Capital Advisors. RBC Capital Markets raised its year-end S&P 500 target to 6250. Investors are also keeping a close watch on tensions between the White House and the U.S. Central Bank. We're going to read about that as well. While traders have almost fully ruled out a July rate cut, the probability for a September move stands at around 60%, according to CME FedWatch. I'm not sure. I think it's more of a 50-50. I guess we'll see after tomorrow's report. Let's dig into Trump tariffs. Trump demands more concessions as EU holds off on U.S. tariff countermeasures. The European Union said on Sunday it would extend its suspension of countermeasures to U.S. tariffs until early August and continue to press for a negotiated settlement as U.S. President Trump's administration demanded more concessions from trading partners. Trump said on Saturday he would impose a 30% tariff on most imports from the EU and Mexico from August 1, adding to similar warnings for other countries and leaving them less than 3 weeks to hammer out framework deals that could lower the threatened tariff rate. White House economic advisor Kevin Hassett said on Sunday that countries' trade deal offers so far have not satisfied Trump and the tariffs are real without improvements. The president thinks that deals need to be better, Hassett told ABC's This Week program. And to basically put a line in the sand, he sent these letters out to folks and we'll see how it works out. Head of the EU's Executive Commission, which handles trade policy for the 27 member states, said the bloc would maintain its two-track approach: keep talking and prepare retaliatory measures. We have always been very clear that we prefer a negotiated solution, he said. Decision to resist immediate retaliatory measures points to the European Commission's desire to avoid a spiraling tit-for-tat escalation in the trade war, while remains a chance of negotiating an improved outcome. German Chancellor on Sunday said he was really committed to finding a trade solution with the US, telling German public broadcaster ARD that he will work intensively on this. Asked about the impact of a 30% US tariff on Germany, Merz said, if that were to happen, we would have to postpone large parts of our economic policy efforts because it would interfere with everything and hit the German export industry to the core. The latest salvo from Trump and the question of how to respond may test the unity of the member states, with France appearing to take a tougher line than Germany. The bloc's industrial powerhouse, whose economy leans heavily on exports. Macron said the Commission needed more than ever to assert the Union's determination to defend European interests resolutely. A first package in response to US levies of 50% imported steel aluminum that would hit 21 billion euros in US goods was suspended in April for 90 days to allow time for negotiations. Yeah, I mean, the markets are generally ignoring these commentary, and I think they think that Trump will tackle. So let's move on to Hassett. White House probing Fed renovation costs authority to fire Powell. I'm going to read the summary on this one. I don't think anything is going to come off of this. I think this is just political rhetoric. The White House is investigating the Federal Reserve $2.5 billion headquarters renovation project, citing a $700 million cost overrun. While the Fed defends the project as necessary for safety and efficiency, the Trump administration is exploring whether the cost overruns justify firing Fed Chair Jerome Powell. However, legal experts argue that the president lacks authority to remove the Fed chair without cause. This is ridiculous. Let's move on to actual news. Meta CEO Mark Zuckerberg touts AI build-out, says company will spend hundreds of billions on data centers. Meta CEO Mark Zuckerberg announced on Monday that the company plans to build several massive data centers across the US, including one it expects to come online next year. The news follows a slew of pricey, high-profile AI hires at Meta. Meta Superintelligence Labs will have industry-leading levels of compute and by far the greatest compute per researcher, Zuckerberg wrote in a post on Threads. Last month, the social media giant invested $14.3 billion in Scale AI and brought on its CEO, Alexander Wang, and hired former GitHub CEO, Nat Friedman, and Safe Superintelligence CEO, Daniel Gross. The company also poached Apple's head of AI foundation models, Ruming Pang, according to Bloomberg. The hires are part of the company's effort to develop superintelligence, or high-powered AI capabilities that are beyond human intelligence. To do that, Meta has launched its own superintelligence lab, pointing to the technology's importance for the company. To power all of this, Meta said it is investing hundreds of billions of dollars into the hardware needed to research and run those kinds of AI capabilities. The company said it will bring 1 gigawatt supercluster data center called Prometheus online in 2026. The company is also building its Hyperion data center, which says it will scale up to 5 gigawatts over the next several years. A gigawatt is 1 billion watts of electricity, enough to power as many as 800,000 homes for a year. Meta said Prometheus will be located in New Albany, Ohio, and refers to it as a multi-region data center. Hyperion will be built in Louisiana. That facility, the company explained, will be large enough to cover a large chunk of Manhattan. Meta is in a race to develop the new generation of AI capabilities, battling rivals, including Microsoft-backed OpenAI, Amazon-backed Anthropic, Google, Perplexity, and others. The company has faced headwinds more recently as it was forced to delay its latest AI model, Llama 4th behemoth. Part of the effort is related to Meta's desire to break free of its reliance on third-party companies to power its business. Meta's Facebook, Instagram, WhatsApp, and Threads apps are all subject to Apple's and Google's respective App Store regulations. At times, that has limited Meta's own business plans and expansion efforts. It's also why the company made its initial push into the metaverse and why it's investing heavily in its augmented reality glasses. But so far, the metaverse has been far less successful than Meta's social apps. Its headsets have sold well, but aren't nearly as ubiquitous as smartphones. And while the Meta Quest AR VR headset is a standalone platform, the company's Ray-Ban Meta smart glasses still require users to connect to a smartphone. Let me just read the summary on the seat. Meta construction 5 gigawatt. I think this is the same thing as we just read, so we're going to skip this one. EU calls X in talks for in 4 talks after Grok chatbot's anti-Semitic posts. Yeah, I mean this was a pretty big embarrassment, and I think the CEO in part got probably fired because of this, but we don't know exactly why she quit. Officials from the EU will hold talks with representatives from Elon Musk's X after the company's Grok chatbot caused outrage by spewing anti-Semitic posts on the platform last week. The EU's executive branch will hold a technical meeting on Tuesday. Thomas Regnier, the European Commission's spokesperson for digital affairs, confirmed. Regnier called it a usual step in the Commission's supervisory work. X was forced to take down a number of Grok's posts from the platform last week after it praised Adolf Hitler and the Holocaust, drawing widespread condemnation. The company deleted the offending post and apologized, blaming a faulty update. The Anti-Defamation League wrote on X that the posts will only amplify and encourage the anti-Semitism that is already surging on X and many other platforms. A Turkish government minister blasted Grok last week for sharing inappropriate content and threatened to ban X in the country. Government officials from Poland and Germany called for more aggressive action against the company. The Commission has previously said that it considered Grok as an integral part of X, putting the bot within the remit of the EU's Content Moderation Rulebook, the Digital Services Act. X is already facing an investigation under the law that focuses on several allegations, including deceptive design, lack of transparency, and platform manipulation. No shit. Fines under the DSA can reach as much as 6% of companies' annual global sales. Representatives for X didn't have an immediate comment. Grok is inferior to Chat, GPT, and Gemini in my experience so far. And that's Grok 4. I guess we'll see if anything changes. I'm not holding my breath. Bitcoin rally seems to be driven more by institutional demand than speculation. As Bitcoin hit a record high on Monday, evidence from institutional flows and derivatives suggests its rally might be more stable and lasting than the previous speculative runs. Bitcoin crossed $120,000 for the first time on optimism over upcoming US House discussions on digital asset regulation, extending its gains this year to about 30%. The rise has been fueled by strong flows into Bitcoin exchange-traded funds and rising corporate treasury allocations. Analysts said Bitcoin's surge is driven by this time by institutional flows and reflects its evolution into a more stable asset, sought after as investors seek diversification from market volatility and a wobbly US dollar. Institutional inflows tend to be longer term and less prone to rapid reversal, lending greater stability and durability to the current rally. Bitcoin ETFs have made a strong start to July, attracting $3.4 billion in inflows so far. That includes a record $2.2 billion over the past 2 days, the largest 2-day net inflow on record, according to data from Farsight investors. At the same time, open interest in Bitcoin futures rose to a record $57.4 billion as of Friday, according to data CoinDesk shows. Open interest tracks the total value of outstanding futures contracts, and a sustained rise often points to greater institutional involvement as larger investors tend to hold bigger and longer-term positions and use futures for hedging. Yet, funding rates in the futures market remain subdued. According to CoinDesk, the annualized funding rate stood at 10%, well below the 80% peaks of 2023 and 40% at the end of last year. The funding rate reflects the cost of traders pay to keep bullish leverage bets open in the futures market. A decline signals they're less willing to pay to stay in those positions, a sign of reduced speculative demand. Glassnode data shows Bitcoin's estimated leverage ratio has declined to 0.25, down from 0.32 at the start of 2025. The leverage ratio compares how large traders' futures bets are relative to the amount of Bitcoin on exchanges. A lower ratio means those bets are backed by more real capital and less borrowed money. Glassnode data also showed an increase in short liquidations as traders betting against Bitcoin bought back the token as prices rose, adding momentum to the rally. Interesting. And a note on China. This publication says we warned about the first China shock. The next one will be worse. Let's read the summary on this. Actually, let's read the article on this one. By David Otter and Gordon Hansen. Dr. Otter and Dr. Hansen, economics professors, pioneered research into how Chinese competition ravaged American manufacturing. The first time China upended the US economy between 1999 and 2007, it helped erase nearly a quarter of all US manufacturing jobs. Known as the China shock, it was driven by a singular process: China's late 1970s transition from mice-side central planning to a market economy, which rapidly moved the country's labor and capital from collective rural farms to capitalist urban factories. Waves of inexpensive goods from China imploded to economic foundations of places where manufacturing was the main game in town, such as Martinsville, Virginia, and High Point, North Carolina, formerly the self-titled sweatshirt and furniture capitals of the world. 20 years later, those workers haven't recovered from those job losses. Although places like these are growing again, most job gains are in the low-wage industries. A similar story played out in dozens of labor-intensive industries simultaneously: textiles, toys, sporting goods, electronics, plastics, and auto parts. Yet, once China's Mao to manufacturing transition was complete, sometime around 2015, the shock stopped building. Since then, US manufacturing employment has rebounded, growing under President Obama, the first Trump term, and President Biden. Why doesn't Trump get the president title? That's weird. So why, you might ask, are we still talking about the China shock? We wish we weren't. We published the research in 2013, 2014, and 2016, along with our collaborator David Dorn of the University of Zurich, which detailed for the first time how Chinese import competition was devastating parts of America through permanent declines in employment and earnings. We are here to argue now that policymakers are spending far too much looking backward, fighting the last war. They should be spending much more time examining what's emerging as a new China shock. China's Shock 1.0 was a one-time event. In essence, China figured out how to do what it should have been doing decades earlier. In the US, that led to unnecessarily painful job losses. But America was never going to be selling tennis sneakers to Temu or assembling AirPods. China's manufacturing workforce is thought to be well in excess of 100 million, compared with America's 13 million. It's bordering on delusional to think the US can or should even want to simultaneously compete with China in semiconductors and tennis sneakers alike. China Shock 2.0, the one that's fast approaching, is where China goes from underdog to favorite. Today, it's aggressively contesting the innovative sectors where the US has long been the unquestioned leader: aviation, AI, telecommunications, microprocessors, robotics, nuclear and fusion power, quantum computing, biotech, and pharma, solar, batteries. Owning these sectors yields dividends: economic sprawls from high profits and high wage jobs, geopolitical heft from shaping the technological frontier, and military prowess from controlling the battlefield. GM, Boeing, and Intel are American national champions, but they've all seen better days, and we're going to miss them if they're gone. China's technological vision is already reordering governments and markets in Africa, Latin America, Southeast Asia, and increasingly Eastern Europe. Expect this influence to grow as the US retreats into an isolationist megasphere. A little political article. Okay, on that note, thank you very much, everybody, and I'll chat with you all next time.